Good afternoon and welcome to the QUIXANT PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives in the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to John Jay, our CEO. Good afternoon to you, sir.
Good afternoon to you all. Thanks very much for joining the QUIXANT PLC 22 interim results presentation. I'm just going to start by taking you through a brief summary of the business. So QUIXANT PLC is a technology business and we look to provide outsourced solutions for a range of markets where electronic equipment manufacturers have a need for technology which is not met well by the standard solutions available from computer and electronic manufacturers. And we focus on specific vertical markets where we can bring hardware, software, display and mechanical engineering expertise, which we have built globally within the business and enable us to become a key technology partner for those customers that we work with in those selected sectors. The first sector we identified in 2005 when the company was started was the casino gaming market. And within that market, we have designed a bespoke computer platform solution. And why that's valuable is because it enables the manufacturers of the casino machines who also write the games to outsource this critical component of the computer platform to QUIXANT, and that allows them to focus increasingly on the game software, which is the most important part of their offering and is what drives the key differentiator for them against their customer base. In 2015, we went on to acquire Densitron, and Densitron has got a 52-year pedigree of supplying industrial display products to a global customer base. Why that's so valuable is through Densitron, QUIXANT identifies new markets that are outside gaming, and it looks to identify in those vertical markets opportunities to move up the value chain in those sectors. So what we look for is markets where there's a transition occurring, there's a trend occurring where that trend is not easy to establish through standard technologies available in the market. And because of that, we've got a portfolio of patents that we've generated where we've identified areas where we can innovate and develop bespoke technology. So we've got 22 patents granted and several under application, and we've got a series of registered trademarks as well. QUIXANT's a very global business, so we have 230 employees spanning 9 countries, many languages spoken across the country, and customers across 50 countries. So we really are truly a global business spanning time zones from the west coast of the US all the way across to Japan in the Far East. And we've historically had a strong double-digit growth track record, 17% CAGR since flotation to FY21 revenues. So it's a strong growth within the business. Just sort of diving into what we do within gaming. So on the left-hand side, you can see one of our orange boxes installed in a customer slot machine. So we provide that hub of all of the computer hardware and some of the low-level software for our customers. And why we do this is because when the casino gaming machine started to evolve into video slots, those video slots needed a computer, but the computers that are available from the broader technology space don't meet the requirements of the video slot market particularly well, principally because of regulation and because of the feature sets that are needed to drive modern video gaming machines. So therefore, the customers that were developing these new round of machines, which sort of started to gather steam in the mid-2000s, were spending a lot of money on computer platform design when actually that didn't drive a significant amount of their differentiation and commercial success. So what we did when QUIXANT came along is we enabled them to outsource that computer platform to us. And that enabled them to balance the investment they were making in computer platforms with its commercial differentiation and increase significantly the investment they were making into game development. And that generated for those customers increased level of differentiation and player attraction to their machines. The market is a very big business, so there's around $1 billion of addressable market for us across the globe. And a handful of names on the slide there are the sort of the largest of the gaming machine manufacturers, some of which or all of which in some extent we work with. And overall globally there's about 9 million units install base with a replacement cycle of the video slot part of that of 4 to 5% per annum. And typically for a video slot, the average lifetime is 3 to 5 years. And over that period is the lifetime of our product. So every 3 to 5 years, customers would look to upgrade their product to the next generation platform. So that's gaming. Just coming on to Densitron. So Densitron has a pedigree in supplying the industrial display components, as you see on the left-hand side of the slide. What we look through that display components business is to identify new sectors where we're already supplying that display component, but we can leverage our group's engineering expertise to migrate up the value curve to higher value products. And the control surfaces opportunity that we saw was in the broadcast sector. And what we've brought in broadcast is revolution of the way you interact with broadcast equipment to move from mechanical type input technologies to touchscreen type technologies. And this requires additional functionality in the form of computing, in the form of graphical user interfaces to enable those touchscreen type technologies to revolutionize broadcast. So we've brought that to the market through a range of products, including innovative and patented tactile touch technology, which allows you to feel the touchscreen as well as to see it. And then we also went on to buy a business in 2019, which adds software to the mix. And all of these additional elements of the offering enable us to increase the unit price and increase the margin that we're able to achieve within that. So broadcast is our next significant market after the gaming industry, and we believe that that has the opportunity to deliver double-digit growth at more attractive margins than the rest of the Densitron business. So making good progress within Densitron towards that objective. So overall, just on the investment case, we've got a proven effectiveness in delivering innovative patented products to key markets. And we look for that sort of market transition and the market characteristics which drive a barrier of competition. And that's through a combination of domain knowledge, so specific understanding of what the market needs are, a regulation, if possible, in that market, and then also just simply that we have the hardware and software engineering disciplines covered within the business. And those disciplines span multiple different geographies. So we blend the very, very high quality experience of the Far East with the innovation and the creativity that you can get in Western countries. In the gaming market, we've generated a very strong position and we have delivered a strong recovery from some of the challenges around COVID. And we've now got new business momentum and that's combined with an ability to deliver on that new business through a proven ability in the difficult supply chain environments that we're facing today. Companies historically had a very strong balance sheet and continues to have a net cash position on that balance sheet, and we're cash generative. And we believe there's significant opportunities for further growth available within the gaming sector and indeed in the broadcast sector to diversify our revenue mix. So that's what we do and a bit about why hopefully we're an interesting investment. I'm going to come on to now talking a bit about how we've performed over the last 6 months. So we've had a really strong trading period in the 6 months to June 2020. So we've had very buoyant customer demand and we've underpinned that by signalling order intake being ahead of the current year revenues, which have been significantly up on the prior year, and also that order intake has been ahead of the prior year order intake that we had. So that sort of buoyant customer demand really is only tempered by the supply availability that we've had. And that's a really challenging period that we're facing around supply chains over the last 18 months or so, with the shortages that have been plaguing the electronics markets. Despite those supply chain challenges, though, we've seen significant revenue growth, as I've said. So gaming revenues have been approaching pre-pandemic levels, and Densitron has had a second period of the highest ever 6-month revenue since acquisition. So good performance within the business in the last trading period up to the end of June. Pleasingly, we've also seen early stages of recovery in gross margins. So last year, we passed on price increases we were seeing on the input side through to customers, and we were playing catch up with that with the ongoing increases in component prices. But as those have started to level off, and they haven't in the aggregate gone down yet, but they've leveled off, those sale price increases that we effected during 2021 have started to now filter through the P&L and benefit the profitability. And that profitability has also been benefited by higher production volumes, which is driving operational leverage So overall, a good progress in improving our margin performance back to former levels. Supply chain risks I've talked a bit about, but we took action early last year to introduce a strategic stock purchase program. That's been extremely important for managing the business through these turbulent supply times. So retaining customers through avoiding stoppages in their production and reducing the impact of price inflation that we experience, but also our customers experience, has been enabled by that strategic stock purchase program. And what that was required us to do is to deploy our balance sheet to buy stock, which enabled our inventory to provide that lifeblood of raw materials into our production. And whilst that has resulted in an outflow of cash from operations, it's been incredibly important for us to underpin our ability to supply and deliver those strong trading periods that we've seen in the first half. Also really pleasingly is we've also made good progress on new business. So we have been working for some years now on generating business from our turnkey cabinet solutions, and I'll come on to exactly what those are. But in gaming, we saw an opportunity to develop more than just a computer board, but also to move up the value curve and to deliver full turnkey cabinets. And those, I'm pleased to say, we announced last week that we've had our first mass production order for $4 million. And that order is due to be delivered in the fourth quarter of this year and into next year. So it's a good progress on our gaming cabinet solutions as well, which is a strategic shift that we're pushing to increase our value to our gaming customers and to support them through the difficult supply chains that we face today. So with that, I'm going to hand over to Johan, who's going to take you through a bit more detail on the financials. So Johan, over to you.
Thank you, John. Good afternoon, everyone. The slide sets out some of the financial highlights for the first half of 2022 compared with the first half of 2021. And as John said, a really strong half for the group. Revenues of $53 million, up 46% on the first half of last year, and also sequentially higher, 5% higher than the second half of last year. Gross margins, we started to see the recovery there with gross margins of 31.6%. And the improved gross margins coupled with the higher revenues meant that we were able to grow both our profit before tax and EPS by triple digits to $3.5 million and 4.1 cents respectively. So a really strong performance in this first half. We have seen an outflow of cash flow in the first half, 3.6 million in operating cash flows. That was predominantly due to the investment in working capital that we've made to secure stock to continue to meet existing and future demand for our customers. And as John said, I think without that investment, much of the performance in the first half would not have been possible. At the end of June, the group still had $12 million of net cash, so a good operational liquidity and a strong balance sheet moving into the second half of the year. Moving on to the next slide, which sets out the group's half-yearly revenues for 22, and then comparatives going back to 2018. You can see the impact that the pandemic had on the group in 2020, but we've recovered from that with the first half of this year being the fourth half year of consecutive growth, and are now consistently back to pre-pandemic levels of about 50 million for a half year. Not only are we growing revenues in absolute terms, but we're also pushing to grow a stronger, more diverse revenue base. The chart at the bottom left shows revenue from our top 10 customers as a percentage of our overall revenue, with revenue concentration broadly the same in the first half, but still improved compared to the pre-pandemic. This is in part due to the higher contribution from our Densitron division, and also continued diversification within our gaming customer base. It's a key metric for the group, and it's something that we continue to monitor at board level. Our order intake in the first half has been more diverse, and looking ahead to the second half and into 2023, we expect revenue diversification to continue. This slide just sets out our revenue by division. Starting with gaming on the left, again you can see the impact that the pandemic had on gaming in 2020, but recovering from that and now back to pre-pandemic levels for gaming, with revenues in the first half of this year up 71% on the first half of last year, and also 9% higher than the second half of last year. This has really been driven by strong demand from our customers, with order intake in the first half ahead of order intake in the first half of last year and ahead of revenues in the first half. We've also benefited from continued resilient management of our supply chains, which has meant that we were able to ship 22,500 platforms in the first half of this year, up 45% on the first half of last year, and the highest shipments since 2018. Densitron, on the right, was not as heavily impacted by the pandemic, but again, strong continuous growth over the last 4.5 years, with the first half of this year being another record high for the division at 21.9 million. What's particularly pleasing with the Densitron growth is that it's broad across all of the subsectors, particularly the broadcast sector, which has grown by 43% year over year at elevated margins compared to the rest of the Densitron business. Sticking with gross margins, and this slide shows our group gross margin in the first half compared to the previous halves going back to 2018. You'll note in 2021 a decline in gross margins. This was principally due to component price inflation because of the supply chain shortages, which depressed our gross margins. We've seen a recovery in the first half of the year, and the recovery really affects three factors. First of all, as John had noted, we've seen a leveling off in component pricing, which has allowed the effect of customer price rises that we put through in 2021 and early part of 2022 to positively impact our margins. We've also benefited from a higher proportion of gaming revenues, which is shipped at a higher margin, and as we've shipped more gaming revenues, that's supported our margins. And then finally, as our overall group revenue has increased, we benefit from operational leverage, leading to lower cost of manufacturing. It's really these three factors combined that has led to the recovery in gross margins, and this was delivered despite what is still a very challenging supply chain environment, specifically freight costs that are still elevated compared to pre-pandemic. We have taken actions to recharge these to our customers, and are continuing to look to maximize our gross margins. Moving on to our profit and profit before tax of $3.5 million in the first half, nearly 3 times the level for the first half of last year, principally due to the higher revenues year over year, adding $5 million of profit, additional upside from the improved margin rate. We have seen an increase of $3 million in our operating expenses. This has been principally due to increased headcount, as we've added sales and product development heads to support the existing and the future growth of the business. We've also seen the effects of cost inflation in our cost base in the first half of the year. Largest part of this was wage inflation. Now we've tried to balance the need to retain top talent with higher wages by increasing those wages and focusing on the variable pay structure and share-based payments to link the payment structure to the group's performance. Looking ahead to the second half of the year, we expect that cost inflation will continue to have an effect on our operating expenses. But despite that, we expect our profit margins to increase in the second half of the year, approaching double digits, with this upward trend expected to continue into 2023. And then finally, our net cash position. The graph on the right shows the movement in the first half of the year, with net cash of $12 million at the end of the half. The largest movement for the half year, as I've mentioned, is the investment in working capital that we've made, principally securing stock to secure demand for our customers, for existing demand, and for future demand. And without these investments, we would not be able to deliver the revenues that we have in the first half. Apart from the working capital investment, we also continue to invest in new product development with $1.2 million capitalized in the year, and we've also made tax interest in these payments of $1.6 million in the year. Looking ahead to the second half of 2022, we expect a further cash outflow, in part due to the dividend of $1.9 million that we paid in August, but also because we expect that working capital will remain at these elevated levels through the balance of 2022. Looking ahead into 2023, we expect improvement in working capitals alongside the improving supply chains. And with that, I'll hand back to John.
Thanks, Johan. So wanted to take you on a bit of a tour of what's happening globally in the gaming market, because it's really quite stark numbers that are coming out, particularly from the North American market. And really importantly, North America represents 60% of our gaming business. So it's a very critical market for us. And after that low we saw in the second quarter of 2020, entirely inflicted by the pandemic and the casino closures that were widespread across the whole of the US in March, very quickly that market recovered rapidly, and actually it was certainly a V-shaped recovery that we saw in the sort of the latter part of the second quarter and into the third quarter of 2020. And from there on in, the gaming market's been going great guns in the US commercial land-based casinos. And so we've actually seen through 2021 record revenues being recorded in US commercial casinos, and that's continued in 2022. So actually Q2 22 was an all-time high for land-based commercial casino revenues in the slot space. So incredible performance coming through from the North American market. And just sort of characterize where that sits. So this is our customer's customer and the revenues that they're generating. So what that says is not directly correlated towards what we can sell into, but what it shows is that US gaming market is very much buoyant right now, and historically has been very stable in downturns. So on the basis that we are facing potential recession, historically in downturns economically, the gaming market has been relatively resilient. The European market was much slower to recover. So in 2021, it didn't see that bounce back that the North American market had, really because lots of European economies were much slower to reduce the COVID-related restrictions that were in place. And so you didn't see that bounce back that you saw in the US. However, the European Gaming and Betting Association is predicting a significant growth in that market back to pre-pandemic levels in 2022, and we've seen evidence of that coming through in terms of customer demand and new business activity. And then Asian markets, so in particular the Macau market, remains heavily subdued. So COVID restrictions still weigh heavy on the Macau gaming industry. However, historically, Macau, whilst it's a very big market from a revenue perspective for global gaming, is a very small slots market. So it's a very much a table games market, and therefore slot machine numbers are very limited in that area, and therefore it's been a very small proportion of our addressable market. So whilst Macau is still very much in a sort of a COVID-related limited revenue, it is a very small proportion of the video slots market which we can address. So not heavily impacting our revenues. So to talk about the cabinet offering, I think it's important to understand what's going on within our customer base. So customers are increasingly struggling with hardware. It's been a trend of outsourcing for a number of years now, and that's why we've won business for our computer boards. But actually hardware in general is increasingly difficult, particularly in this current supply environment. And so what the cabinets offering does, it allows customers to outsource all of the hardware that they need to do to bring a slot machine to the market. So we don't get involved in any of the software, that's entirely in their domain, apart from that sort of low-level plumbing software that enables their game to interact with the hardware. But what this cabinet enables them to do is to entirely outsource their hardware offering to Quixant. And what we bring is something that's designed for purpose as a regulated gaming machine. They then add their game to it, and then they go and get their license and deploy it into regulated gaming markets. And what this does by bringing the cabinet offerings out is it executes part of our growth strategy to increase our share of the customer wallet. And I'll go through the other areas in terms of the growth drivers in due course. So typically these products are aimed at the smaller end of the market, and typically at the lower cost gaming markets. And as I said, it enables those customers in those areas to focus exclusively on game software development, which, as I said at the beginning, is the key driver to their commercial success. We've got two offerings. We've got the electronic gaming machines, and we've also got the self-service betting terminals. So the latter is designed for sports betting kiosks, and the one on the left is designed for video gaming slot machines. And the first order we've had is for the EGM cabinets, and that's a $4 million order that's going to be deployed into the US gaming industry. So really exciting strategic progress on our cabinets offering and driving further that outsourced trend that we believe is very much alive and kicking. So within Densitron, we've covered the fact that Densitron's had an excellent trading period. It also built on that resilient trading through the pandemic. And it's very pleasing to see that some of the efforts that we've had around improving that business, driving new focus markets such as broadcast, and indeed enhancing the core display components business, is now delivering rewards in terms of financials. And part of that growth comes from our first focus sector, the broadcast market, which grew 43% year on year. And why that's growing is because we've got an increasing pipeline of opportunities within that market, and we're landing revenue within those opportunities for a wealth of products, including some of the higher value products that we've developed. We've also continued to make investments into that, part of our increase in OPEX, and some of the key hires we've had in Q3 are a senior product specialist coming from Grass Valley and a broadcast sales leader. So focused individuals, entirely exclusively focused on the Densitron broadcast sector. And then we've also launched a number of new product offerings, including announcement in August of the IDS Cloud SaaS solution, which takes what we previously supplied as an on-premise control system that's used in some very high-profile customers in the professional broadcast market, but now can be available on a deployment as a cloud SaaS solution. So exciting evolution of our broadcast product offering, and part of the reason why we have that confidence in future growth within that broadcast sector. And then the display components business. So since we bought Densitron in 2015, we've done a lot of work to transform that business and give it that opportunity of single-digit long-term sustainable growth within the core Densitron display components business. And that sits alongside the double-digit growth we get from the focus sectors such as broadcast. So some of the work we've done is around centralization procurement, and that's been incredibly important in the current climate, where we've had our expert purchasing team in Asia sourcing and managing the difficult supply environment, and improving our operational efficiency so that we can get our sales teams much more focused on new business and sales growth. We've also got better management information that's enabling more management-driven KPIs to improve our sales success. And also we've terminated non-performing business units and product offerings over the period since we bought the company. So overall, all those changes we believe has driven a better availability of product and enabled us to have a competitive advantage in what is a very competitive display components market. So display components also seeing good momentum in trading alongside the double-digit growth we've announced in the broadcast sector. So overall, from the group, how do we talk about growth? So we follow a series of steps that defines our growth strategy. So we identify a target market and we look for that technology change. So if we take the gaming market as an example, the technology change was about the mechanical reel-based machines going to video slots. In the broadcast market, it's about the mechanical control solutions going to touchscreen-based digital solutions. So we look for that technology change, and then we look in that market whether there's any existing providers which are already developing a product which provides an outsource for the manufacturers of that equipment. And if it doesn't, that market may well look interesting to us to participate in. We then try and acquire customers within that market in the chosen segment, and we then try and increase our share of the customer wallet by providing additional outsourced solutions and becoming a more integrated partner to those customers. And we will invest in R&D as part of that so that we have that higher value of product, including adding software to the mix. And where necessary, we may also augment that organic growth with strategic acquisitions which add to our technology capabilities. So we've made good progress in all those areas as identified on the slide here. So we've had another consecutive period as our second growth market within broadcast, alongside the extremely strong growth within gaming. We've converted new customers within gaming cabinets, and that sits along progression of pipeline within gaming boards and broadcast. And in terms of increasing our share of the customer wallet, our gaming cabinet mass production order confirms our ability to migrate up the value chain within gaming machines, not just supplying a computer board, but also high value products within that. And we've also continued to evolve our R&D efforts around the broadcast markets. We've launched Tactilla, and we've also launched the IDS Cloud offering, which has been delivered to sample. A sample has been delivered to customers. And we continue to have a very robust balance sheet and a net cash position. So should we see acquisitive opportunities, we have the ability to take advantage of those. So overall, in summary, we have an ongoing strength of order intake, and it's broad-based across multiple customers and multiple sectors. And that gives us good confidence in future growth in high-quality revenues. And we talked at the beginning about that order book or order intake that's above current period revenues in the first half. And that really is only constrained by our availability to supply it based on supply shortages. But nonetheless, our product offering is extremely strong. We continue to invest in that. And our brand strength, I think, is at an all-time high as we're working so hard to look after customers and deliver them with the stock availability. That's pushing customer momentum. And so although there are many macro uncertainties remaining, those are around supply environment, the pricing volatility, and around sort of macro political factors, we believe that our experience in tackling these issues means that we can take advantage of that buoyant market demand as we go forward. And so we upgraded our expectations for full-year revenue and profit in July. But given our support of a strong start to H2 and excellent order coverage, we are very confident in achieving those upgraded expectations. So longer term, we've got a growth strategy, which we believe that through disciplined execution of that strategy, we can deliver compelling long-term growth coupled with improved profit margins in the business. And we're very, very excited about what is achievable within that, taking us to new highs on revenue and profitability. So I'm going to finish on that and hand over to Q&A.
John, Johan, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab, which is just situated in the top right-hand corner of your screen. But just while the company take a few minutes to review the questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. I'm just turning to the questions. Could I ask you to read out the questions and give responses where it is appropriate to do so, and then I'll pick up from you at the end.
Thanks very much indeed. So the first question we've got is, what is your contingency plan in the event China blockades or invades Taiwan? So it's an excellent question. It's obviously very newsworthy at the moment. And we are implementing a contingency plan for that event. So currently, a lot of our gaming manufacturing is done in, or all our gaming manufacturing is done in Taiwan. And Densitron is manufacturing some in Taiwan and some in China. So we are going to have multiple sources of manufacturing also in sort of the Southeast Asia region, but potentially in other countries, not Taiwan, but we'll continue to manufacture in Taiwan. I think that, from a sort of a group stability point of view, we have, a very, very much sort of a cloud-based deployment of our IT systems. So the IT elements wouldn't be affected by that. The raw materials for semiconductors all are coming out of Taiwan. So 90% of the advanced semiconductors are produced by Taiwan. So in the event of a sort of full-out war with China, it would be very, very difficult to find a contingency plan for any businesses that are in the technology market, whether it's consumer or industrial. However, what we're seeking to do is to have multiple locations for manufacturing backed by stock out of country, outside Taiwan, and then also to hold finished goods stock that is not in the Southeast Asia region. So we have warehouses, for example, in North America, and having some contingency for that. I would also add that I think that there is a lot of news flow around this area, and I think that the likelihood of an all-out sort of war is relatively low. It's much more of a long tail event. I think that the likelihood is more elements of economic sanctions, and clearly having manufacturing diversified across multiple countries helps us with mitigating excessive taxes or what have you that might be enacted as a result of that. So it is something that we have got on our risk register. It's certainly gone up in our risk register, and we're now executing our contingency plan to mitigate against any unexpected but still plausible risks that happen as a result of that. Second question we've got is around visibility. So the question is very good performance with good visibility into 2023. do you expect current levels of revenue becoming the new base level from which to grow? And the answer very simply to that is yes. We are expecting this being a sort of continued ongoing recovery. We've talked about the strength of order intake, that being ahead of revenues, and the trading momentum being in an upward trajectory. We've talked about the first few months of H2 being strong, so we are expecting the revenues currently to be something that we build upon as new business converts and as supply chain eases and we're able to supply more of the demand. And next question that's come in, can you talk about competition in your markets? Are they seeing similar growth or are you taking a share? So mixture of things in that. So within gaming, we don't see the gaming market overall as growing. In fact, if we look historically, it is growing on a low single-digit basis. But overall, we conservatively view the gaming market as flat. But what we are seeing is a push towards more regulated gaming in comparison to sort of illegal, unregulated gaming. That certainly benefits our business. And what we're also seeing is more customers seeking to outsource versus in-source their designs, and that is driving an increase in our share of that market. If we look across other parts of the business within the broadcast sector, there is very much a narrative there around how much is hardware going to be part of our business versus should there be more focus from our customers on software, and should we help them with doing the hardware aspect. So that is certainly about gaining share. And overall in broadcast, there was certainly a glut of capital expenditure through 2020 and 2021. We've really started to see that resume in the second half of last year and into this year, where new projects are coming back onto the table again. And more broadly, within the sort of the Densitron business, I think our ability to supply and have better availability, we have been seeing a share gain coming in that, but it is a very big market and we have a very small share of it compared to, say, the gaming market, where we think we're about 10 to 15% of the annual replacement cycle. That's all the questions I can see on the screen. If anybody's got any others, please do ask.
John, Johan, thank you very much for that. I think you've addressed those questions from investors, and of course the company will review all questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to you both, John, could I just ask you for a few closing comments?
Yeah, sure. So we're very excited, as you probably can gather by how the business's trading momentum is building. And we have had a number of challenges that have hit us over the last few years. But we've worked our way through them, and certainly I think it's very important to call out the team effort that's been within the business globally. Everybody's worked very hard to try and tackle those challenges head on and deliver the kind of trading results that we've had. But going forward, we believe that the work that we've done, the platform we've built, positions us extremely well for a longer term growth track record, and that growth track record being more diversified than it has been in the past. And with a wealth of compelling business opportunities, with a strong balance sheet and a good platform to build from, we believe the next few years will be an exciting period of opportunity and growth for Quixant.
John, Johan, thanks once again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Quixant PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.